Real life.
Hi, everybody. Welcome back to another edition of VCTV. I'm your host, Kyle Ellicott, and today we're going to be talking about SPACs. While you think the digital currency boom is all the rage right now, let me tell you about SPACs. This is the industry that is on fire. We saw a ton of companies going through SPACs to fundraise in the public markets, and we're going to define a little bit more about that process here in just a moment. But we saw a ton happen at the end of the year 2020. Well, guess what? We're still not even at the end of January, just a few days out, and we're already starting to see more activity in the SPAC sector around public markets than we did in 2020 as a whole. There are predictions that we're going to see even more activity this year than we ever have in the past. And Noble's going to correct me on that if I'm wrong, as he is an expert in this area, along with all of our speakers today over the last decade as well. So get ready, and we're going to dive in here in just a moment. But before we do, a big thank you to your audience for tuning in. If you're liking what you hear today, click subscribe, share, and check out the archive as well to hear more, not just about SPACs, but from all of our speakers today and the entire VCTV family as we bring together the best and the brightest from around the world to share with you their thoughts and insights and on-the-ground perspective around different technologies, industries, and regions around the world. And if you would like to be on a show like today as an investor or as an entrepreneur to pitch us your company, product, or service, along with getting feedback on your company or exposure to our entire live audience in the VCTV community, do reach out to the team and or myself, and we'll find that right spot for you. Speaking of the team, a big thank you to the LATOKEN team and to Maria for making VCTV possible every single day. With that, I'm your host, Kyle Ellicott. Let's go ahead and jump in, introduce today's guest, and talk about SPACs. Noble, I already kicked you off earlier in the beginning of the show, so I'm gonna let you start us off today. Little intro, little background, and maybe a little bit more than usual, as this is, again, an area that you have focused on quite a bit in the past.
Sure. My name is Noble Dracone. I'm the author of the books Winning the Trading Game and Trade Like a Pro. I also am the managing partner of Dracone Capital Partners and the president and CEO of a mobile app gaming company called Where Play Games. We at Dracone Capital Partners do a lot of interaction, particularly on the Canadian Stock Exchange, where there's several SPACs that have been set up. And we help people find the capital necessary to find investment, find money, the like. But it's very interesting what's going on in the SPAC space. And it's one of those situations where there's more money than deals that we've been discovering lately. And a lot of SPACs are starting to hit their 2-year mark. So I'm really looking forward to this conversation in a big way.
And the 2-year mark, I want to come back to that, as that seems like a very important fact. And speaking of more SPACs in terms of money than there are deals, just heard moments ago before we started here on VCTV, Constellation Group also just launched a SPAC. They're actually focused on ESG, something we talk commonly here about on VCTV as well. But to that point, according to CNBC, while they've launched, they have yet to find a deal as well. So again, back to Noble's point to validate. With that, Swati, welcome to the show as well. A little intro, a little background. Wonderful introduction. We can't hear you at the moment. There you go. All right.
Sorry about that. Getting used to this Zoom webinars has not been easy over the past year. But anyway, delighted to be here. Hello, everyone. My name is Swati Chaturvedi. I'm the co-founder and CEO of PropelX. PropelX is an online investment marketplace where we enable investors, accredited investors around the world, to invest in startups. Our specialty is deep technology companies. So companies founded on breakthrough science or breakthrough technologies. Aside from that, I also am a partner at a small fund which invests in, it's called the Newton Fund. Newton Fund invests in companies that appear on the PropelX platform. So that's who we are.
Love it. And for those who have not checked out PropelX, please do. Swati and her team put together an amazing platform. And we will be talking about fundraising in our next episode here on VCTV later today around early stage investing and why what Swati and her team have put together is so important. So stay tuned, check it out. But as we continue, Nicole, welcome back to the show. A little intro, a little background.
Thank you, Kyle. It's a pleasure to be here and with this wonderful panel. Yeah, I wear many different hats. You've heard me say that before, and it's a great analogy because I don't want to look too crazy being involved in a lot of different businesses, but that brings me joy. I love building businesses, and I have a consulting firm, marketing strategy consulting firm called Outfront Solutions. And I'm also a partner in a couple of different funds, How Women Invest, and we're investing in female-led and female-founded startups, as well as Andrew Capital, which is investing in growth and late stage, as well as Seed Milestone Fund. So I like to, take a good look at startups, jump in, do proper due diligence, which maybe we'll talk about today, maybe we won't, and get them out into the marketplace and help them raise the money that they're looking to grow.
I love it. And yeah, I mean, getting companies out into the marketplace when it comes to fundraising, that due diligence piece, it's all a part of this world of SPACs that we're going to be talking about. So you're absolutely right, Nicole. Gary, Grandmaster of Artificial Intelligence himself, a little intro, a little background. Welcome back to the show.
Thanks, Kyle. It's great to be here and great to see some friendly, familiar faces. It's fantastic. Anyhow, my name is Gary Fowler, and I'm an investor, serial entrepreneur. I write a lot. I've got a couple of shows, including a new TV show. I love artificial intelligence and quantum computing. I've done 17 companies. I've been involved in 2 unicorns. I was in the original management team. Click Software was sold to Salesforce 21 months ago for $1.35 billion. Also, I'm the co-founder of Viva, Eva.ai. Eva's another unicorn that, it's funny because, and I just thought about this recently. We call them unicorns, but, a unicorn's a mythical creature. And it's kind of weird that we try to strive to something that's not real. So I just, I'm in a dilemma right now. So whenever I said it's like, is it a horse with a horn? I don't know. It's something different. A rhino? But anyhow, so I'm also an investor. We're building a $100 million impact fund, in the process of that. Also, we have our private money in, several of us in a fund. I built a $10 million seed fund that's fully deployed. And we just closed our first deal in Africa today. So we have an African startup. What we do is we believe that opportunities are not equally spread around the world, but intellectual capacity is. So I really put in a big push in all parts of Africa. I've been on the phone with Egypt today and Qatar, all over, just because we want to bring this world together and try to make a little dent in the universe. So we're looking for AI companies and quantum companies there, and we can help. I am the CEO, president, and co-founder of GSD, Get Shit Done Venture Studios, a premier AI and quantum venture studio.
Thank you very much. And thank you all again for sharing your thoughts and insights today, as we're going to jump into a very important topic that's relevant more than ever. As Noble said, there is a ton of capital out there, these groups looking to invest in companies, and not just us as investors, but also this rising group, not new, but rising category and groups around SPACs, and opening up to the public markets and helping companies at various stages. To Nicole's point, as she looks at companies early to late stage with some of the funds she works with, from the SPACs perspective, we've seen it all over the map. Companies in the earliest stages all the way to the latest stage that normally would be going into that IPO stage, but instead look at SPACs as not necessarily an easier, but a quicker path. I should say I had to stop about 7 different words to use there, which Noble will correct me on, a more streamlined path to going into the public markets to grow and expand their business. And Noble, I want to come back to you to kick us off on a little bit more, maybe what is a SPAC? Why is this now so important and so relevant all of a sudden out of the middle of kind of nowhere as we came out of 2020 and going into 2021?
Yeah, you intersect a lot of things at once, right? So first of all, SPACs are not new. When I grew up in the financial industry, they're called blank check companies back in the late 80s and early 90s. And they fell out of kind of favor because the regulators didn't like how they functioned and operated. oftentimes not investing, and there's a lot of fraud at that time with a lot of blank check companies and how they execute it. So they kind of have had a re-evolution, partly because of Virgin Galactic, right? So Virgin Galactic is one of the most best known SPACs out there, in which you had a group raise the capital and buy Virgin Galactic into Virgin Galactic for over $800 million. And since then, everybody's been chasing. Pershing set up their own SPAC. They raised over $2 billion. And it's been an interesting kind of how the rules have set up with that, are that you have to find a deal within 2 years. The SPAC itself can't touch the money. It sits in a separate account except for interest. And so they actually generate money off the interest that's sitting there to run operations. So the more they raise, the more interest they generate for themselves. Even though in a low interest rate environment, who knows what that looks like. But there's a lot of other things happening on the other side of the table as well. SEC, and most people have been reading these rules for a while, are decreasing how expensive and the likelihood for companies to go public. So it gives SPACs an opportunity to be an alternative regardless, because a lot of private companies that want to go public didn't want to go through the gauntlet regardless. And now with the pathway getting less expensive and the opportunity to be listed easier, why not? And we know that in Canada, between the TSX and the Canadian Stock Exchange, they've been very aggressive at courting the entire idea of SPACs and people being able to list. And it made it very easy, relatively easy and inexpensive to set it up. But there's kind of an intersection between reality and capital. And people have said it, all this in the investment space, Gary knows it, we all know it. There's really more money than good ideas to be able to invest in. And a lot of these SPACs are very specialized in the space, because you have to find people who are familiar with deep tech, like Swati said, or you have to find people who are familiar with, we run into companies that are mining companies only, and they might want to mine gold, and so they're very, very specific in their project mandate. And so what happens is, while it seems on the surface like they're really great opportunities, particularly for private companies, because you end up making about 20% more when you do a SPAC, reverse into a SPAC. They actually are a nightmare too, because their deal flow is tremendous, and if it doesn't meet their mandate, they can't step into it. So there are some SPACs that have, for the last almost 2 years, reviewed over 200, 300 deals, and none of them really work for what their mandate is, and so they haven't done it. So the smartest one was the Virgin Galactic deal. They built the SPAC to invest in Virgin Galactic. That was the goal. It doesn't seem like a lot of SPACs are really keeping that in mind, that you have to already have your target as opposed to fishing for targets. And so I'm frankly confused at why they become so popular, with so many of them not being able to hit their mark. Maybe it's an opportunity just to park money for some companies and for some people. So I have no idea.
Mm-hmm. Well, and that very well could be the case. Speculating here as well with you, that could be the case. As again, I mentioned, there's one that just launched today, and part of a blank check company is, as you said, I mean, they've got money, they're putting it to work, generating interest, and then if they find something, they find something. If they don't, it dissolves, or they can continue on, right, and expand it as well. But want to continue this discussion, and also want to hear a little bit more about diligence, because to your point, Noble. Companies, these SPACs act very similar to funds. They have mandates, just to make an easy comparison. I know there's very big differences, audience, but for an easy comparison for today's discussion is they act like funds. They have a mandate. They also have to do their research, and they have to do diligence. So when you're doing diligence and not just looking at investing in the SPAC, but the SPAC themselves, I mean, what are companies looking for? What are SPACs looking for in companies? And maybe Nicole will come to you next on this around diligence and kind of opening up, the hood of the car there and looking at what is there and what's not, and why this may make sense or may not for the SPAC. So talk a little bit about diligence in the process. There you go. Sorry.
Yeah, absolutely. I'm not necessarily the expert on the SPAC amount of diligence, but I'm definitely of age where I knew it took a company public. My first company was acquired, and we took organic public during the .com boom. And I knew what that process looked like and felt like. At the time, we had stacks of papers this high, and everyone, and including my grandmother, knew what I ate for breakfast that morning. And I mean, the rigor of the diligence when you IPO is a whole different thing. And so with SPACs, that's where it comes into play. Is it aligned with the investment thesis of the SPAC? What rigor needs to happen in terms of the diligence? It's nothing like what the diligence of an IPO. However, SPACs right now are accounting for 70% of the investments in the public offerings. And so it's a little scary. And I mean, I'm a marketing person by background, and even I'm saying, wow, this is pretty overhyped, and it's making me nervous to see these SPACs just sit there and not make their acquisitions, and kind of pull the process forward. So I'm interested, as you all in the audience are, in hearing what the others have to say about this on the panel.
Yeah, absolutely. And thank you, Nicole. And Sawadi, I want to come to you around not only diligence, but also some of the companies that you work with, whether it's through the Newton Fund or Propel. I mean, are they starting with you and then looking towards this? Is this a conversation you're having with some companies? But let's start with that and then maybe get into the diligence. So
yes, absolutely. So look, I'm coming here with two possibly conflicting perspectives, right? Back in 2016, I had written an article in Clean Technica saying that clean tech companies, which at that time were going through this downturn, at that time I had said that clean tech companies should be exploring the public markets for capital. Why? Because clean tech companies are perceived as these capital intensive companies which takes a lot of capital, and most importantly, the lives of these companies are more than the 10 years, which is the life of a fund. So a venture capital fund would tire of them in 10 years, and the idea would be that, how do I get rid of it? And these companies after 10 years stop getting access to the funds. And so the point I made in that article was that take a leaf from biotech companies, explore the public markets earlier. So that is one point, that I felt that clean tech companies particularly needed access to public markets earlier. However, coming to the situation playing out today, we have companies which are super early. They have no revenues. They are going public through these SPACs. And the situation is not like it was before, where there was less capital. Today, there's ample capital floating around, whether it's in the public markets, private markets. So the question to ask is, okay, why did they not raise from the private markets when there is capital? If there was a dearth of capital, I would understand. But there are these companies that are going out when there is sufficient capital available. And so is that correct? And that is worrisome. And there are these, like EOS, you're talking about that, Noble, 200x of sales. That's their market capitalization. I mean, that is unheard of. So the point I'm bringing these two perspectives together, even though they conflict, there is an intersection here. Yes, there are some types of companies that should explore public markets. I'm very happy that these avenues are being explored, especially for deep tech companies, which tend to need money. And they tend to need a lot of money over a long period of time. So that's awesome. However, I do believe that investors should be a lot more skeptical. They should conduct a lot more diligence on what's going on. Currently, the disclosure requirements, because these are blank check companies, they don't have to disclose much when they're raising capital. So the disclosure requirements are very limited. By and by, eventually they'll have to put out their annual statements, etc., at which point it will be disclosed. But the companies they are buying up are risky. I mean, we do understand EOS and all these battery companies, for example. So it is conflicting perspectives, coming together. On the one hand, I'm happy these public markets are being explored, but on the other hand, I feel investors should be skeptical. So that is my opening. You did ask about diligence, right? And I feel like investors should be more diligent, right? They should be asking questions. I'm worried that there is this company with no Nicola had what? $36,000 in revenues. I mean, that's less than what most startups have, you know? So, and they're going public at this humongous valuation. I think that is worrisome. What is the diligence behind? And those revenues, by the way, were not even from their main business. So they're from an ancillary solar installation business. So it is worrisome. I want to raise these flags. Yeah, I can expand on that endlessly, but I'll not take up all the airtime.
No, I actually do want to come back to that in a minute here. I'll come to Gary and then we'll come back to that, because it does come full circle to all of us as investors that you have to do your research. Yes. You have to do your diligence, whether it be in a private deal or a public deal, smallest of the small to the biggest of the big, you have to do your research in any way and every way you possibly can, because you're bringing up a great example. And, you know, no revenues. Okay. Every company starts with no revenues in most cases, and you know they grow revenues over time. But if they've been around for 5-10 years and have no revenues, where's the path towards revenue? Or are they always going to be continually raising money? And that's a different type of company. That again, risk appetite is different for everybody. But you know, Gary, I want to come down to you. I mean, you're seeing a lot of this activity around SPACs. You've seen it globally. Now it's coming again here to the US. We're seeing more activity. What are you starting to see around this? Is this something that is worrisome? Is this something that it's exciting? Are you talking about this with companies that you work with as well?
Yeah, so I wrote an article about SPACs, and you know, and I have the same kind of viewpoints that Swati and Noble and Nicole have, but at the same time, you know, I learned one thing. You know, I've been an entrepreneur for over 34 years actually, and 35 years. And one of the things I learned is you need to take a leap of faith. At some point, if you're going to be successful, and all my billionaire friends, and I got a number of them, have all done the same thing. You take a leap of faith. So it's one of them said to me, you know, Gary, it's very simple. He said, if I have a coin, give me a coin. This is a real deal. And this is a billionaire. He said, give me a coin. Do you have a quarter? I said, yeah. He said, now here, give me the quarter. I'm going to flip it. And he said, what is it? I said, heads. And he said, okay. He said, if you wouldn't have tried, you have 0% of success. But he said, by trying, you won. He said, and you know, entrepreneurship, this guy's got a PhD in business too, DBA. And he said, that's what business is all about. And I learned that lesson very early on. And I understand that today. So when people, and Scott McNeely, I don't know if you ever heard of Sun Microsystems. So I had lunch with Scott probably a year ago. And we had an amazing conversation. And he said, always seek areas that you fear the most, because that's where the opportunities and that's where you learn. And I never forgot. I heard it years ago, and then I had lunch and we reconfirmed it again. And so from my standpoint, the situation, yes, SPACs, there's a lot of challenges, but at the same time, you know, if you bring some of the experts together in a particular area like AI or quantum or whatever it is, robotics, you bring people together, you're hoping they're going to make the right decision. The other thing is you got to have some trust in the individuals that are forming these SPACs, and they are experts in the area. So I would research them and see how much you know about them. And of course, there's a lot of companies that are BS that are out there. Your job is to go down through. It's not like a Dutch tulip. You got to figure out, hey, listen, what is the revenue? These are like, keep it simple, stupid questions. What's their revenue? What's their team? What's their go-to-market strategy? And what kind of traction do they have, and what's their pipeline? These are simple questions. But if you don't ask the questions, whose fault is it? And so what'll happen is, in my opinion, it'll start to be really regulated. When it starts to go out of whack and people see it, you're going to bring the regulators in and they'll start to put the hammer down. But I have known some SPACs in a similar situation a number of years ago that were successful. But again, it's do your due diligence. Understand what you're getting into. Look at the people that are running it, just like you would evaluate any investment decision. And at the same time, you got to have at some point as an investor and entrepreneur, you got to have some leap of faith. I mean, it's Lance Armstrong. I remember hearing him on a show, and I'm not talking about his own personal background, but his investment. And he had said, I believe Uber, that he had a chance to invest in Uber, and he didn't know that much about it at the time. And he invested money in Uber, and that really brought him back. So, and I heard a guy from Bitcoin 2 weeks ago, I had a conversation with him. He bought a 800,000 or $1 million worth of Bitcoin at 50 cents, and people were laughing at him. And we had this conversation. I was with his partner, and it's funny because he doesn't, you don't realize how much money you have when you're a multi-billionaire now, because you made $1 million investment years ago. So part of it is having a leap of faith. I mean, people didn't believe in Bitcoin at the time, and e-commerce, when we started our first e-commerce consulting company, people said, I don't really think this is right. Nobody's going to buy online. There's too much thievery going on. It was a debate. Amazon's never going to go beyond books. So anyhow, I believe you got to stay positive, have a leap of faith, and at the same time, trust but verify.
Yes. And I see shaking heads. Noble, go for it. You already unmuted. Go for it.
So there's two intersections, right? I was a big investor in Web 1.0 and e-toys. They don't exist. So, we have these great bets that people make, and as entrepreneurs, we love making these aggressive pushes. But the problem that, and I like the concept of SPACs because you get a chance to pick the industry you want to participate in. We also like the idea of betting on a good horse, right? So if they've succeeded in the past and the founders are created in the past. Problem with this diligence is that nobody knows what's happening until post. That's the issue that I have with it. It's not so much that we should do our diligence and read financials. All of us are capable of that, and most semi-sophisticated investors are capable of doing it. What diligence can you do? I mean, at this point, you're putting and they're raising capital in the public markets prior to doing the acquisition. And we're not even as investors on the acquisition team. So we don't even make the final decision on what's being acquired. So it's that intersection of, yes, there's a great opportunity to take a leap of faith. I'm still holding on to Dogecoin because I really liked it. I'm still holding on to Litecoin because I thought it was going to be the next push. Those haven't reached levels. Now, mind you, I have Bitcoin and some other things. So it's always that, cautiously optimistic and deal with probability versus possibility when it comes to investment. And I think that this is where it's starting to wear thin on the SPACs because the probability of them finding deals is incrementally and almost exponentially decreasing as time goes on, as more companies are putting money into the space versus the likelihood or the possibility of them getting those particular deals actually funded. I've talked to multiple companies now who are having to redo the paperwork and do refilings and spend money to extend the life of their SPAC, as opposed to just changing their investment thesis in order to make it more palatable to find the deals. So yes, I'm all for taking a chance. I mean, I completely agree with you, Gary. The unfortunate part is it's so obfuscated in our view on what that chance really is. What is the likelihood when someone sets up a SPAC? Have you already identified these 20 companies that you're going after? And that's where there seems to be almost a disconnect, that people are so in a mad rush just to file the documents. And I've told people this many times my entire career, just because you filed your exemption or your Reg A or whatever you've done doesn't mean you know how to raise money. Now, these guys have successfully filed it, raised the money, means they don't know how to find the deals. So it's become this drive that, they've done all the regulatory component, they've done all the component to get started. So it's, I think it's a great novel way to invest, but I think it's almost a way for people to kind of suck up all the oxygen of deals. So we know that almost private placements have almost done $1 trillion, where people use Reg A, 506Cs, and have raised money off the books, to Swati's point, that they never needed to go public. Most of the private deals have been financed and funded just fine for the last 5 or 6 years with no drive to go public. So now it's almost like these deals are sucking in those same investors who would have gone private, now locking up and committing their money to the public markets with anticipation that they're going to find a deal. And it just seems like somehow everything's being moved from the left side to the right side with, I think, almost disastrous results if it gets to the point of where we go from 60% to 80% of these SPACs being here. And it's not, a matter of just them finding the deals, but them just locking up that money for 2 years. That slows down deals that could have been done on the private sector. So it's just a mixed bag. And I think that I like SPACs. I think there's great opportunities. I think there's some really solid ones out there with good mandates and are aggressive in finding what they need. It's really finding the ones that are on point from day one who can meet that 2-year deadline without issue. And you know, it's going to be less and less and few and far between to really determine that, particularly if you invest early on, not knowing what's going to happen for 24 months.
Well, and it's opening up more avenues for fundraising as well, right? I mean, we look back 10 years ago, there was just a few outlets, respectfully. And a few years after that, there was even more. And then we started seeing the rise of crowdfunding and crowdsourcing. And we started seeing the rise of syndicates. And now we've got rolling funds. And now you can take capital from almost anybody anywhere in the world, knowing them or not knowing them, big or small, right? We've got so many opportunities now in front of entrepreneurs that want to raise capital, all the way from, again, those very small checks, if you will, and respectfully, all the way up to the public markets. And this is now just increasing that opportunity zone in so many ways. And I see shaking heads left and right. Swati, anything to, or go ahead, Nicole. Sorry, you unmuted first. So Nicole, anything to add on that?
Sure. No, it's just so interesting because, you know, I'm close to a number of female founders, and they were one of which took a company public via SPAC years ago, and then when she was creating her second company, she was actually literally positioning it from day one to go public through a SPAC. And so she was, you know, already considering that as a major fundraising vehicle from day one and building up her company. So it's, you know, I think, you know, no matter what, humans are going to come up with these financial products, these fundraising products, and get creative. It's just, you know, taking the money, you know, taking the air out of the room. I mean, you know, funds like SoftBank, you know, it's, you know, have increased 34%, and they haven't even made an acquisition. You know, it's just, is it a parking lot, you know, for a lot of folks? And are there going to need to be these extensions because they're not aligned? The companies that they're seeing, the deal flow that they're seeing, are not aligned. And I'm absolutely with Swati. I love the fact that this lends itself to clean tech. It lends itself to mobility. It lends itself to these markets that, you know, are longer term and are pretty capital intensive. But I'm also hearing, you know, David Solomon, the CEO of Goldman Sachs, putting out warnings saying, uh-oh, rebalance. Is that because he wants, you know, eyes to turn in different directions? I don't know. But it's just, it's something to keep watching. And for, as the panel has been saying, investors have to do their own due diligence in maybe even a deeper way.
I think that's great. And Swati, go ahead to continue.
Yeah, so I actually, I think Noble makes a great point that what is the due diligence to be done, right? Because you're really backing the people. There is no company. We don't know what the target is. They don't disclose it. We know the sector, right? What is the due? So when we say due diligence, what does it mean? So let me just expand on that a little bit. I am worried about the market capitalizations at which these companies are being taken public. I'm worried about the multiples that they're being, and the reason for that is they have to deploy all their money, and it is kind of like a quasi exit. So they are thinking, oh, if this company, which by the way is a midway startup company, if it actually went through to its exit, this would be its market capitalization. So hey, let's put it out at that market cap, raise all that money, and then work backwards from it. The problem with that thesis is that there's many a slip between cup and lip. You don't know what's going to happen, right? So this whole working backwards doesn't quite work out. That is the problem here, right? So that is what my concern around this is. I feel like the bankers that have been backed rightly, but I think SPACs are a great vehicle because they're giving individual investors and, like you said, another avenue to access private markets. Awesome. I think the responsibility lies on the managers of these SPACs. Why are they taking these companies public at these phenomenal valuations, which are not justified, right? And that's why you do see the prices are falling for some of these SPACs, because, you know, you can fool some people some of the time, you know, but you can't fool all people all of the time, whatever that thing says, however that thing goes. So that is what I mean when I talk about the diligence and the valuations and who are these bankers that are taking them public? Where is that sense of responsibility? My sense is there is going to be greater regulation. Right now, they're not required to disclose targets. Nobody discloses targets. Hey, you don't want to raise the price ahead of time. But I sense that something will have to be done about these disclosure requirements for SPACs. But if regulators are listening to this, please let me put in my word here. I think SPACs are an awesome vehicle. They should persist. We just need to modify them a little, you know, just like an entrepreneur would iterate the product a little bit to make it suitable for the audience. That's my point here.
Absolutely. And a question for all of you is where to start? You know, all this points, and again, we're talking and speculating on what's happening in the market and our knowledge of SPACs. So please, again, everybody who is listening, do your research before making any kind of investments, but hopefully this is educating you on the opportunity. And if I am a founder looking to go through this process, what are some of those steps to even begin to think, okay, I want to go into a public market, I want to market myself to be a part of or to be purchased by a SPAC. What do I do? Where do I start? And this is kind of an open question to the group. I would love to hear all of your thoughts, but and Gary has done an article, Swati has an article. I've shared both of those with the audience as well, because they're both great and relevant. But the question to the group is where to begin? Where do I start as an entrepreneur if I'm even thinking about and maybe prepared for that opportunity? And I'll see who jumps in first, or I'll call on somebody. Swati's already unmuted, so
I'm happy to share.
All right, go
I'm
ahead.
happy to share.
Noble had you backed up, but we'll go for it.
It's very easy. The list of SPACs is public. You know the sectors. Find your way to link into the managers, period, right? If you're an entrepreneur, you're looking to do that, that's the way to do it. And I can say that that's something that we're all, not for ourselves, but there are some companies that we know that are working on it in that very fashion. For SPACs, it's harder, right? Because you need a company, you need to find that needle in that haystack, which, by the way, fits all these criteria. And so they are the ones that have to do the marketing. And a fair bit has already been done through the IPO process, right? Where they have advertised their sector, they've said we're looking at such and such targets. So a fair bit has been done. So now they have to do that they have the two minds have to come together, the two sides have to come together. They have to go through these 200, 300,000 of startups that probably apply to them. They have to find that right one. So to your question though, how does a startup find that right SPAC? You know, it's all available, publicly available databases. You know, just link in to the right people, and that's how you work your way through it.
Absolutely, thank you. And Noble, you had unmuted, so I'll throw it to you. Anything to add?
No. I mean, Swati said it best. You know, that one is almost like shooting ducks in a barrel, right? You know the sector, you know that they have the money, and you know who is operating it. Now you just have to fit the gauntlet of their needs and what they're looking for. But on the flip side, you know, I've worked with a lot of family offices for years. And one of the problems a lot of family offices have is a sense of urgency, lack of sense of urgency, combined with over deal flow. And they, you know, because they have an opportunity to pick and choose. And unfortunately, I don't believe the 24-month timeline is enough a sense of urgency for the SPACs to aggressively sift through the mountain of people who introduce their opportunities to them. And it's possible, and again, I think SPACs are great. And again, I'm with Swati, you know, I'm not saying get rid of SPACs, but something has to be done so that they can actually get through all the different people submitting to them and get through the deal flow so that they can actually operate on their mandate quicker than later. Because, 2 years for a company that submits as they're going through can be the difference between the company going out of business or being able to get the capital they need to expand and grow. And so if someone submitted at the beginning and they still haven't gone through your application, your documents, or whatever due diligence they were doing, the deal still has to take probably another 12 to 18 months just to go through the process of filing paperwork, figuring out if this is the deal we're going to close, what's the percentages are. So, it adds a lot of time for particularly businesses that are in desperate need of the capital, or they believe that they need the capital in order to grow and market, and it can slow down their growth and market prospects. So I do suggest those people who are chasing the SPAC don't diminish or stop their private equity raises at the same time. And I've always been a believer that, as an entrepreneur, we're running the marathon while tying our shoes at the same time. So you have to still continue to do your raising, even with the hopes that the SPAC that you maybe submitted to is interested in you and wants to bring you on board. Don't look at one investment source or one source of capital as a panacea for all your ills. You still have to run your company. And it's one of those unfortunate components after being an entrepreneur for the last 28 years that we're always fighting with, right? That we have to function and run the company, sell the widget, and sell the company at the same time so that we can continue to sell the widget, which allows us to then attract more people to sell the company to. So it's that Sisyphus wheel that we're always kind of aggressively pushing on with the Damocles sword of any moment, any one of those components can break on us. So just as an entrepreneur, constantly stay focused on why you're doing what you're doing, and look at all these capital avenues is just one other opportunity in many that you're pursuing to make sure your widget gets out there.
Absolutely. Gary, anything to add? Thank you, Noble and Swati.
I mean, like I said earlier, it's do your research and check it out. And I mean, this is just standard business. I mean, if you're trying to sell a company, you don't just go to one group, you go to many groups. So you want to diversify your risk and build some competition too. So the same rules apply. Sometimes we forget the rules. We get too focused and we forget the rules. So use your just normal business logic, diversify your risk, look at multiple ways. I mean, you don't want to be in a situation where you work on a SPAC opportunity and find out, for whatever reason, that their mandate is expired, and they're not going to be able to work with you. So look at other opportunities. But this is normal business. It's exciting though. Don't give up. Try it. And it may work. So just normal business. I'm very interested in it, but I'm also very interested in all kinds of innovative ways to do things differently.
So speaking of this, I want to switch gears real quick. I mean, SPACs we've talked a lot about is a unique rising opportunity or category for companies to fundraise. But looking at the fundraising landscape as a whole, it's dramatically changed in the past 18 months. Coming from the decade before, where again we introduced a lot of new areas of opportunity for companies to fundraise. The last 18 months has really accelerated that and maybe even expanded it, where now companies, as we've talked a lot about here on VCTV, can raise from investors anywhere in the world, right? We saw the Reg CF, and you can correct me if I'm wrong, Noble or Swati, on that, but we also saw the Reg CF expand from just over 1 million to around 5 million. Thank you. $5 million where companies can take in from non-accredited investors and continue to grow and scale their business. We've got areas in Southeast Asia, specifically the Hong Kong Stock Exchange, that has introduced a third stock market, if you will, where companies with less than, I believe, 99 investors and little to no revenues can actually start to go public. We've got reverse mergers, we've got SPACs, we've got rolling funds, we've got all these different areas and opportunities. I'd love to hear from each of you as we come to close, your closing thoughts on where we go from here over the next year in the fundraising market and opportunities for companies, because a lot has changed. Each of you invest differently. We'd love to hear your thoughts as to the next year. How will the fundraising environment evolve for companies at all stages? And Noble, let's start with you. And then of course, where can everyone find you as we come to the top of the hour?
Yeah, it's easy to find me, Noble Dracone on LinkedIn. You can type me in on Google, you'll find my books and stuff. And if you want to reach out to me on Twitter, which I'm not very good at responding, but I do my best, you can do @Dracone on Twitter. Bottom line is, as an entrepreneur, be bold. This easy money environment will not last forever. The easy money started from the governments at 0% rate and borrowing. And that's what a lot of is fueling a lot of this. And now that the winds have changed a bit and we're heading into a different direction, you have to be aggressive and bold. To Gary's point, you've got to flip the coin. You know, you have to make the big bet on yourself, your business, your concepts, and then aggressively start pursuing all avenues unabashedly. You know, whether it's dealing, you know, the 506C, my favorite, unlimited investors, unlimited space in the accredited as accredited investors, Reg CF, all of these things have the changing of the rules of what an accredited investor is technically. These things have all allowed for entrepreneurs to be hyper focused and to find the capital they need. And in this dark times that we're slowly edging out of, right? It's the time now for people to make those moves, regardless of where they go after the capital. Just go after it and explode your business.
Thank you very much, Noble. Gary.
Yeah, so with this past year has presented a lot of challenges. We were stunned at the beginning of the pandemic. People weren't sure what to do, how to do it, because the traditional way of raising money and meeting with folks of, for me, going down El Camino Real and going to Hobie's and having breakfast or lunch was just one of the ways. It was just a standard, and those ways have changed. So part of the way that you do it today is through trust. And how do you build trust? Well, you build trust through exactly the way we are here today on VCTV, because people got to know who you are. The other thing is you need to get your presence out everywhere. So writing, coming up with articles. I had another billionaire friend of mine one time said that the way that you do it is you become an industry expert in a specific area. So I would go out and be passionate about it, love what you do, but actually research it and become an industry expert in a particular area and really focus on it. So it's a great opportunity. The one thing that happens with at the beginning of the pandemic is that people really scattered. They were afraid. They hunkered down. The companies that did, the VCs, were bold and moved forward, found some incredible opportunities at a discounted rate and have done those. But we need to keep the diligence. We've gone through an incredible digital transformation over the last year, and it's not over yet, right? Even with the with regulations and restrictions lifted, we're still in another phase of this thing. So the good news is the companies that adapted have a chance of winning. So go get them. You can reach me, Gary Fowler, LinkedIn. You can reach me on Twitter. You can send me an email, Gary at GSDVS. Love to hear from you. We're looking for AI and quantum companies from all over the world that want to go global using Silicon Valley as a port.
Wonderful. Thank you, Nicole.
Yeah, I, just in terms of advice and, focus on running your business. And, I always say this to entrepreneurs is keep falling in love with your business every morning. Wake up, fall in love with it again, because you need that resilience. And this last year has taught us a lot about resilience and agility. And indeed, entrepreneurs and investors have been able to benefit those who have been able to act and quickly and thoughtfully. And, there was a lot of money that was raised on the private markets. A lot of new funds came into being, including our fund, How Women Invest, last year, and raised and closed in record speed. But, and entrepreneurs have this opportunity to learn about all these different funding vehicles and catch that wave. And one thing I know after being in the Valley for many, many years is there are just waves and they come and go. And it is critically important to catch a wave. And it's ideally, it's the right one for you, your company, the right fundraising vehicle. But fundraising is typically a full-time job for entrepreneurs. And they're always looking for ways to streamline that and make that easier and have advocates and partners in it. And it's not easy. So I would say, really make sure that you as entrepreneurs are doing your diligence on your investors, that you know you're fully aligned, that when you wake up every morning and fall in love with your business again, you're also potentially falling in love with your investors and those who are by your side in this journey. So yeah, just keep at it, keep riding the wave and predict the next one, because I don't see anything but tumultuous times still ahead for all of us. And just in terms of staying in touch with me, I'm easily reached on LinkedIn, Nicole DeMeo. Also, check out How Women Invest, our fund investing in female founders, female-led businesses.
Thank you, Nicole. Swati, close us out.
Yes, absolutely. So circling back to the subject of SPACs, what this interest, this billions, hundreds of billions of dollars raised in SPACs, what this tells us is that there's tremendous interest from investors to have access to private companies. That's the bottom line. Why is that? That is because per the SEC's, there's a paper that was put out in 2017. Private transactions were about double the size of public offerings in the US in 2017. Double the size, 3 trillion versus 1.5 trillion. So it's a much larger market. It has the potential to offer higher returns, albeit at higher risk, right? It has the potential to offer much higher returns than public markets. And now there is this trend that all these awesome unicorn companies are staying private longer. So how does the investor access these offerings, right? And that's why there is this tremendous interest in SPACs and other vehicles that enable investors to invest in privately held companies. And that's why we start PropelX. So the thing that I would say from the investor's perspective is look at companies that are curated, that have due diligence behind them, access them through platforms. There's lots of platforms. PropelX is one, which is a platform for accredited investors to invest in deep tech startups. There's other platforms as well. So I think these are all ways to invest where you actually get some insight on the companies that you're investing in, as opposed to just investing in blank checks. And if you're going to invest in a blank check company, that's fine too. Just make sure that you keep tabs on what they're investing in with your money. So that's what I would say for investors.
Wonderful.
Always looking out for the investors.
Wonderful. Thank you all very much.
Sorry. To reach me, you can reach me on LinkedIn. And you can please follow me on Twitter, Swati_PropelX. Please check out our website, propelx.com. Sorry, Kyle.
No, perfect timing. Thank you, Swati. Thank you, Nicole, Noble, Gary. Thank you all very much for sharing your thoughts and insights around this rising category. And again, to those that are listening, make sure you do your research. Talk to those that are experts in this area. And if you're looking to make investments into those types of companies that we spoke about today, again, do your research. We cannot stress that enough here for you as well. With that, again, a big thank you for tuning in. If you like what you heard today, click subscribe, give us a share, a thumbs up, and check out the archive as well for more episodes of VCTV, and also to hear from today's speakers and other different topics, industries, and regions around the world as we bring together the best and the brightest to share with you their thoughts and insights and on the ground perspective. If you'd like to be on a show like today as an investor or as an entrepreneur, reach out to the team and or myself. We'll find that right spot for you. Speaking of the team, a big thank you to the LATOKEN team and to Maria for making VCTV possible every single day. Thank you, Swati. And I'm your host, Kyle Ellicott. You can find me everywhere online at Kyle Ellicott. As we mentioned, with all investors on all social media platforms as well. Make sure you add context when you reach out. And with that, we'll be back here with after a little bit of a break with more VCTV for you as well.